Attention, all Tesla shareholders. I think there is a chance that you might be in trouble here. Let's talk about it. Tesla's story is a very interesting one. Elon Musk has done miracles for shareholders, especially in the period from 2017 to 2021. In just 2 years, Tesla's stock was up 2,000%. If you bought Tesla stock before the pandemic, before 2020, this stock has probably changed your life. Since 21, the story has been a little bit more complicated for Elon Musk and for Tesla and for its shareholders, but the winds are starting to change again. And since 2024, since Donald Trump has been elected, Tesla stock has been performing really well. Elon Musk has made his way to the White House. He is now advising Donald Trump on a bunch of very important issues. And it's safe to say that his buddy in the White House will make things pretty easy for him in the next 4 years. Obviously, the market is seeing this relationship unfold and expecting big things to happen in the next few years. But that's not all. Tesla has recently released their new car model, the Cybertruck, and Elon Musk is announcing big plans for 2025. The self-driving cars and the robotaxi network will be in operation by the end of the year. So with this spiral of good news and optimism, it's easy to see why the market likes this stock once again. The people are voting and they're voting Tesla up. This company now has a PE ratio of 160, which is on the more expensive side when it comes to companies in the stock market. Now, if you're a beginner, all that means is that it would currently take 161 years of earnings for Tesla's shares to pay themselves back based on the company's current earnings. Why is it that expensive? Well, it's because the market is expecting these earnings to grow very quickly in a short amount of time. And so as the earnings grow, the price to earnings ratio will recalibrate to a lower level. All of that is just to say that the narrative is currently looking good for this company, and the narrative is pushing the stock higher. But in this video, I would like to give a word of caution because I believe that there is evidence now coming out that the story for Tesla might be a little bit more complicated than anticipated. We'll be going over all of this in detail in this video. In other news, we have big tech reporting earnings in the past few weeks, and a lot of very important CEOs have come out and expressed that they will be spending a lot of money in 2025 as they build out capacity for AI and data centers. Now, the three companies that I'm mostly referring to here are Amazon, Google, and Microsoft, the leaders in cloud infrastructure. Since reporting those numbers, all of these companies' stocks have been struggling a bit in the past few weeks. For example, since their report, Google stock is down 9%. We'll be talking about this big tech AI Capex spend, what it means for those companies, and what the consequences could be, and why the market is reacting this way. We'll also be touching upon this very interesting article here in the Wall Street Journal. Apparently, the Mag 7 are now a thing of the past, and investors are turning to value once again. And finally, we have Walgreens Boots Alliance reporting that they'll be cutting their dividend entirely in 2025 and beyond. This company has really been on the struggle bus in the past few years. What a fall from grace from 2016 all the way down to today. The company has lost 90% of its market value. Of course, since the announcement, the stock is down nearly 20% as investors flock out of the stock. Most of these investors, I'm assuming, had invested in WBA for the magnificent dividend of 10.6%. Now, this dividend is going to disappear. In this video, we'll be covering why WBA cut its dividend, how did we get here, and as dividend investors, how to avoid situations like these. Let's start by talking about Tesla. This company is on a tear. Tesla stock is up 80% in the past year, and that's despite a 30% drop from the all-time high back in December. Clearly, the market is responding very positively to having the Tesla CEO next to Trump in the Oval Office, and it's expecting Tesla to have outperformance in the next few years based on the stock price movement. Now, this movement in stock price is not just due to Elon Musk now having a lot of power in politics. It's also due to renewed interest and hype in Tesla's autonomous taxi network, the robo-taxi network, and also Tesla talking about AI and robotics. If I look for the word robo in Tesla's latest earning call transcript, I come up with 20 results. So Elon Musk talked about the robotaxi network, robotics, 20 times in this call. Here, for example, we have him saying that robotics will bear immense fruit in the future, immense. And here we have an analyst asking Elon Musk, so I have a question on deploying robotaxis in June in Austin. That's great news. And I was wondering if it means that I can drive down to Austin in June and try unsupervised by myself. Elon Musk answers that Tesla will be testing the robotaxi network and technology in Austin, but that doesn't mean that it will be available to the general public in June. What's interesting is that despite all of this interest about the robotaxi network and robotics, Tesla is still a car company today. Actually, sales of cars and parts of cars and services related to cars account for 90% of Tesla's revenues in 2024. The remaining 10 has to do with battery technology. Yes, the energy portion of revenues is growing really fast. From 2023 to 2024, it grew 67%. That's really impressive. But for now, it's still a small part of the business. Most of Tesla's revenues and profits actually come from selling cars. And so the question is, what's fueling this investment into alternative revenue sources like batteries? It's the car segment. If car sales start to come down and Tesla loses this source of revenue, how will the other segments be funded? So Tesla is still a car company. The rest of Tesla's business, which is expected in the future, the robotics, the taxi network, the batteries, all depend on the Tesla car business. Yet, the Tesla car business is showing signs of weakness. For example, in Europe, which is one of Tesla's big markets, sales are declining drastically in January of this year compared to January of last year. Minus 7% in the UK, minus 37% in Norway, minus 44% in Sweden, minus 60% in Germany, and 63% in France. In the whole of Europe, Tesla's sales are down 50% this month compared to January of last year. That's really bad news for Tesla. And as if that wasn't enough, China is also seeing lower sales of Tesla in January of this year compared to January of last year. The same exact problem. Not to the same extent. Sales are only down 11.5%. But keep in mind, this is a bigger market for Tesla. So, what's causing all of this? Well, the first answer to that question is that Elon Musk is going crazy. Now, that's a bit of a harsh statement, but it's true. A lot of people are giving up on Tesla and refusing to buy the product, being ashamed of using the product because of Elon Musk. In the past, Elon Musk has always been Tesla's biggest intangible asset. The reason why Tesla has always had an insane valuation is because Elon Musk is at the head of the company. People talk about his vision, his genius, the way he manages to make things happen. And when a visionary man leads a company, that company deserves a higher multiple. Well, that same dynamic of having the man dictate the fate of the company is having the opposite effect now. Ever since Elon Musk bought Twitter, now X, and started changing the company and giving his political views a lot more, he's made a lot of enemies. It's a lot of publicity for him, and publicity is never a bad thing, but he's become a very polarizing figure. Now, add to that the fact that Elon Musk is associated to the White House, he's buddies with Donald Trump, and this US administration has been particularly aggressive with tariffs. We all know that. What are the odds that territories like China, like Europe, that are big importers of Teslas, will reciprocate on those tariffs and make it harder for Europeans and Chinese people to buy Teslas, make it more expensive for them? I would say the odds are pretty high. So that's one thing to consider. There's also a boogeyman in the room, and that boogeyman is called BYD. This is a Chinese company. They make EV vehicles, and for the last few years, they've been Tesla's biggest competition. There's a few things to note about BYD. The first is that they currently make the cheapest EV on the market in the world. Their lowest priced model starts at 10,000 USD, I believe, which is less than half of what the lowest Tesla model costs. So even if Trump and the US administration slapped some tariffs on BYD to make their cars twice as expensive, they would still be cheaper than Teslas. BYD is also adding self-driving technology to all of its cars, but there's also another competitor we haven't talked about, which is the Waymo and Uber collaboration. Waymo and Uber are making strides in this market, and they've already announced that they're expanding their number of rides, they're adding their cars to Austin and Atlanta, so things are moving on that side of the market. Tesla is by no means a monopoly in the EV space, and they are by no means a monopoly in the self-driving space. So here's what I think. I think the next 4 years will be the crossroads for Elon Musk, Tesla, and Tesla shareholders. If Elon Musk can deliver on his promises of coming up with a robo-taxi network and Tesla bots, it's going to be in the next 4 years. Now, keep in mind that even though Elon Musk has called out 2025 to be the year where robo-taxis finally see the light, this is not his first rodeo. I had some fun here with ChatGPT and asked it how many times Elon Musk has promised self-driving cars, and this is the answer. In 2013 and 2014, he claims that fully autonomous driving is about 2 years away. In 2015, he says that Tesla vehicles will be able to drive without human intervention within 2 years. In 2016, he says that Tesla will drive itself from LA to New York without driver input by the end of 2017. In 2017, he says that fully autonomous self-driving is coming in about 2 years. In 2019, Tesla will have 1 million robotaxis on the road by 2020. In 2020, Tesla is very close to full self-driving and that the system will be capable of driving without human supervision by the end of the year. In 2021 and 2022, he continues stating that Tesla is just a year away from achieving full autonomy. In 2023, he suggests that full self-driving is improving rapidly and that Tesla will achieve autonomy this year. And finally, in 2024, he claims that the full self-driving technology will be capable of unsupervised operation by mid-2025, with a fully autonomous robotaxi fleet launching in Austin by June 2025. So, will this actually occur? I don't know. And if it doesn't happen, if Elon Musk does not deliver this time, odds are nothing will happen. He's under-delivered so many times in the past, and the stock price has never reacted. Shareholders were always forgiving. So what's to say that this time is different? What I think though is that if he does not manage to show real progress in the next 4 years, so by 2029, I'm afraid that the narrative around Tesla and robotaxi networks and robots will change for good. And when the narrative changes, so will the PE. And let me tell you that if the PE re-rates to the downside, this will be ugly. The next thing I want to talk about here is that big tech is splurging and going all in on capital expenditures. They've all announced it. Amazon will invest $100 billion in Capex in 2025, Microsoft will invest $80 billion, and Google will invest $75 billion. Of course, you'll recognize those three names. Those three companies are the biggest cloud infrastructure providers in the world. And a lot of this capital expenditures will go out to expanding data centers and building out AI capabilities. But going back to those cloud providers and their announcement of capital expenditures, the market is hesitant. And it seems like it doesn't know whether all these announcements are a good thing or a bad thing. For example, Google stock is down 11% since the company announced those plans. The first reason why investors are selling out of these stocks is the lack of near-term profitability. Let's look at this chart of Google's operating cash flows and capital expenditures. We can see that the operating cash flows are going up over time. Google's business is making more and more money, and actually 2024 was a splendid year from that perspective. But if we look at the free cash flow tells a different story. Based on the free cash flow, Google is actually pretty stagnant since 2021. And all that is due to this increase in capital expenditures. Google is making lots of investments, and that is weighing down on the free cash flow. Just to give you an idea, the capital expenditures for 2025 will be around here, and Google's operating cash flows will have to be off the chart at 125 billion in order to keep the same level of free cash flow. So that's the first thing. The second thing, which is probably even more important, is that the market probably doesn't know what the return on investment will be on those capital expenditures. Like I always say, the AI market is moving very fast, technology is improving very quickly, and so it's very hard to see 6 months, a year, 2 years in advance where the market will be at that point. And whenever a company has big research costs or capital expenditure costs, it's possible for that money to just end up being worthless if the return on investment is not high enough. And we have to say it, last week the market was spooked by the DeepSeek entrance onto the scene. If you remember, DeepSeek is a Chinese company that developed this large language model, which is very high performing. It's on par with ChatGPT from OpenAI, but it was trained for a much lower cost. And so the market is thinking, wait, so what if now everybody can make their AI model for much cheaper? Why would they pay for NVIDIA's chips? Why would they pay for Broadcom's chips? And also, why would they pay Google and Microsoft and Amazon for all that extra space? In other words, if the product gets cheaper and cheaper to make, are all these investments into AI infrastructure really worth it? That's a very question to ask if you're an investor in this AI space. And I tend to agree with Satya Nadella here. On the 27th of January, he tweeted that Jevons paradox strikes again. As AI gets more efficient and accessible, we will see its use skyrocket, turning it into a commodity we just can't get enough of. So what he's saying is that as it gets easier and easier to build AI and make AI applications, well, people are going to want it even more. People will come up with more use cases to develop more AI models because it'll just be so easy to make. All these models will have to be stored somewhere, and this is where Google, Microsoft, and Amazon will be winners. People often say that NVIDIA is selling the shovels in the AI gold rush, and I tend to disagree with that. I think the real shovels are being sold by Amazon, Microsoft, and Google, the cloud providers. No matter what happens, these businesses are the toll booths for any AI application to work on. NVIDIA is selling the metal that goes into the shovels, right? That is to say, the three big tech companies, they need NVIDIA's products in order to build the data centers and build the infrastructure. But if one day the cloud providers decide to stop investing in expanding their data centers and just work with the material they already have, NVIDIA could be in some trouble. That is, unless NVIDIA is able to evolve its business away from just pure hardware and move into software and data centers, which they're already doing. But just to summarize, I think that these three companies are excellent companies to invest in, very high quality. And I think the cloud business might be one of the best businesses in the world. It's one of the most profitable businesses and one of the businesses with the highest barriers to entry as well. Which other company in the world can commit 80 billion, $100 billion of capital expenditures in 1 year? Only those companies. And so as time advances and these companies build out all their infrastructure, the barriers to entry go up and the market kind of closes on any new entrant. That's what I like to see. I like to see companies with big moats and that those moats are very profitable. Another thing I think is important to note is that filters, which are very popular, a very popular way of finding stocks nowadays, won't always be right without the proper qualitative analysis. For example, if you filter by free cash flow, it would seem like Google is not producing that much free cash flow because of all the investments they are making. I think this is wrong. And I think in this case, companies like Microsoft and Google, which will have temporarily depressed free cash flows in the short term, they'll actually be able to produce a lot more free cash flow in the long term because of this. And so, as investors, when we look at these companies, I think it's good to give them some grace in a sense. And I think this is why it's important not to focus always too much on the free cash flow multiple. Don't just go by numbers, go by the qualitative analysis. Understand the story behind those numbers. Some companies with a 45 free cash flow multiple are extremely expensive. Other companies, like Google, are probably not. Moving on to this article by the Wall Street Journal, which says, "The Magnificent Seven are so last year, cash cows are the new kings." Every decade or so, someone will declare that the Berkshire Hathaway boss has lost his touch, usually a clue for the reasonably priced stocks he prefers to come roaring back. Even so, value investing, the way that Buffett's mentor Graham practiced it and Nobel Prize winning economist defined it decades later, has had too few rebounds lately. The reason isn't that the Magnificent Seven stocks such as Nvidia, Apple, and Tesla have rewritten the laws of gravity. Value investing just needed a tune up. The article then goes on to mention how free cash flow is now a greater method of valuation compared to the historical way, which was price to book. So, first, let's go over what price to book is. It's a ratio that compares the price of the company to its book value. And book value just means the assets that are on the balance sheet minus the liabilities. So, in essence, book value is a measure of how much net assets a company really owns. And this method used to work really well back in the Ben Graham days. You've probably heard of this book, The Intelligent Investor. It's considered by many people to be the investor's Bible. Personally, I've never read it, and I don't usually recommend it to other people. And that's because I think the principles in that book are antiquated. Yes, there are some lessons that are very valuable, like Mr. Market being a manic depressive. But overall, the method of valuing stocks that's written about in this book, I think, is antiquated. This book was written in the Great Depression times, and it was updated once or twice since then. But this was a time when most of the value in a company was in the assets. It was in machinery, it was in property and equipment. And the reality is that with technology, with the internet, with AI, a lot of these things are not true anymore. In a lot of cases, a company's value is with the employees or it's with the intellectual property within that company. And it can be very hard to actually quantify those things on a company's balance sheet. So, what do people use instead? Well, a lot of investors like to use the price to earnings ratio. But when it comes to the price to earnings ratio, it's based on a company's net income. And net income is an accounting number. That means that it can be boosted or it can be decreased based on the accounting rules that you use. There are many tricks that can be used to either boost the earnings in order, for example, to impress Wall Street, or to depress earnings, for example, to pay less taxes. And companies take advantage of these things by using depreciation, amortization. All of these things can alter the net income, and that can make it hard for us as investors to value a company based on net income. Let me use Tesla once again as an example. The company reported 7.1 billion of net income in 2024, but actually 700 million of that, so 10% of that net income came from Bitcoin price appreciation. And the reason is simple. Tesla holds Bitcoin on its balance sheet, and so every quarter when Bitcoin price goes up, the difference in capital appreciation has to be shown by Tesla on the net income. The same is true when the Bitcoin price goes down. It can be shown as a loss on the net income. So as you can probably tell, the price to earnings ratio might not be the best thing to look at if you're trying to value a company and determine what a company is really worth. In my opinion, the best thing you can use, in my opinion, and in the Wall Street Journal's article opinion too, the best thing you can use to actually value a company is free cash flow. Free cash flow is not like net income, it's not an accounting number. It's a concrete number of how much cash is flowing in or flowing out of the company every year. In a sense, it's a true measure of productivity, and it's very hard for companies to fake this number. Free cash flow is measured by subtracting capital expenditures from a company's operating cash flow. One thing that you need to keep in mind is that on most websites, in most databases, the operating cash flow takes stock-based compensation into account. What that means is that when a company pays employees by issuing shares and getting cash that way, paying them like that, instead of paying them salaries regularly in cash, that appears on the company's cash flow statement, is appear as a positive value. So if you're trying to truly figure out what a company is worth and how much cash a company is generating, you have to remove the stock-based compensation from that calculation. On Rated A, we do that automatically, and operating cash flow here does not include the stock-based compensation. It's already removed. The last story I want to cover here is Walgreens Boots Alliance cutting their dividend and the stock plunging 17% on that news. This stock has simply been a disaster, much like the company itself, unfortunately. On this channel, I was covering Walgreens Boots Alliance 12 months ago, saying it was a value trap, and I made another video 3 to 4 months ago saying it was still a value trap. During that time, Walgreens Boots Alliance stock is down 58%. You can add a little bit to that based on the dividend payments that investors received. But keep in mind that in that same time, the S&P 500 was up 20%. So that is some severe underperformance. The question is, why did it happen? We all know the main culprit. It starts with an A, it ends with a Amazon. To put it simply, Amazon sells the same items as Walgreens, but more cheaply and more conveniently as they can actually deliver to your home. Historically, WBA's main advantage was always location, always the fact that it was super close to all of its customers. And thanks to the pharmacy being a necessity, people would go pick up their prescriptions and splurge on some items from the shelves at the same time since it was very convenient. Well, not only did Amazon mess that business model up, they also are bringing out online pharmacies, which are completely destroying WBA's business model. We also need to talk about capital mismanagement. This one is easier to see with hindsight, but Walgreens sunk a lot of capital into building out these centers where they would combine primary healthcare, where you see a doctor, with the pharmacies. The goal was that by creating an integrated health hub, that's something that Amazon would not be able to compete with. But it was too little, too late for Walgreens because the reality is there was no more cash flow to invest in this new project. A dead giveaway for Walgreens was the free cash flow. This company has been losing cash on an annual basis for 2 years in a row. When that happens, it's just not financially responsible to even pay out a dividend. If you're a shareholder in Walgreens and you're seeing that the company is making investments and losing free cash flow every year, you don't even want them to pay you a dividend because that would be bad for the company. The company was paying more in dividends than the cash it was receiving in free cash flow every single year. So that's a dead giveaway. This company was going to cut the dividend at some point, and it happened. The lesson here is to never take a dividend at face value. Always remember that it's management's discretion to either boost the dividend or cut it entirely whenever they feel like it. The bottom line is that when a company is as bad of a quality as Walgreens Boots Alliance, you see zero mode rating, zero profitability, zero safety, and F quality rating. No matter how high that dividend is, it's probably not worth it because it's going to get cut. So, this is probably the last time I'll be covering Walgreens Boots Alliance on this channel, given that it's a poor quality company and it's no longer paying a dividend. All right, that's all for this video. I'll see you in the next one.